Good morning.
Good morning.
Are we ready to start?
Yes.
Yes, sir.
So,
I see there are fewer people in. Those who don't know me can have a pleasure of looking at me.
lazima hadi mapema ni 7.
May I start by warning those ladies? I'm tired of your sopranos and discussions in my class. Ukiona ni mapema, wewe endelea kulala.
Mwalimu
Na
tuendelee.
mnapenda kusikia watoto wakilia huko kwa klasi yangu. I've said those who don't know me, you can look at me. I've put my video on so that when you are looking for Wasike, you get to the right person.
Oh, this is Wasike. Dr.
Yes,
Dancun.
some of you have come to ask for. Some of you have come to ask for notes. I've given to 3 of you. One is called Dancun. Another one is Okech Mutua. And there's some lady who was in my office called Atieno. So I said, share with your colleagues. And today you can come so that I give you the ones on taxation and also on index numbers, which we have to conclude today. We are getting ready and we'll be starting the lesson in a short while. Just as a reminder, our cut is on next week. So prepare. It will cover up to what we have to cover today. So it will cover the first 3 topics that we shall have covered. Then we are left with the 2, the one on statistics and the one on matrix algebra. That one will do the cut in April. So the procedure is that next week you will have a class and we shall agree and communicate what time the cut will be. We shall keep this cut running for an hour. It will take an hour. Then the system will definitely switch you off. But it will be open for, I don't know how long. We'll be discussing with the McDonald to see how the settings would be. Because if all of you can do it at once, the better. But if all of you cannot fit it at once, then we shall be forced to extend some time, but limit the number of times you will attempt the cut. You will limit the number of minutes in terms of time taken doing the cut. So those ones will be controlled. So if you take too much time, it will definitely switch you off. If you want to attempt the second, the third time, it will definitely switch you off. So you attempt once and you can correct, make changes if need be. For every question, we'll allow one. We'll allow that you may go forward and be given one chance to go backwards to correct if anything. So those are the instructions. Jen, your hand is up.
Doc, good morning.
Yes, morning.
I think you should make it to be 2 hours. Like we've been having some problems. Tunapewa 1 hour, we go all of us uko kwa cut na inasumbua wote. So better you weke 2 hours, uende pole kila mtu wa.
We cannot give you a card for 2 hours. The exam will take 2 hours, so we cannot give you a card for 2 hours.
The problem is that tukipewa hiyo
ukipewa
1 hour, kila mtu anataka kuingia huko, kila mtu anataka kufanya hiyo cut haraka. Ni hivyo portal inasumbua.
Portal inasumbua? Sio nyinyi wenyewe mnasumbua.
We've been not us. Unaenda huko unapata
I've been teaching this course from 2003. So I don't know kusema inasumbua. But I'm here with the technician, the technocrat, the expert in this area. Adiwa inasumbua? Magdi. PSY 2210 has been done by 1700 students and there was no problem. So why do you anticipate a problem, Jen, in this?
Excuse me, Doc. Good morning.
Good morning.
How are you?
I'm fine.
Thank you so much. Allow me support the lady. We have been having several cuts like last semester concerning using the same portal and using the same links that we have been sharing.
Yes.
And I assure you now that we have been having countless problems when it comes to cut, an online cut.
You've been having countless problems.
Yes. Because at a time, the cut is given the date, the time.
Yes.
Then being that all of us are first years and we are rushing. And because we don't want a missing mark.
Why do you want to rush?
Of course, that is how our first year behaves. Because all of us, we don't want to have a missing mark.
Yes.
So at the time you find us getting into the portal at the same time. The portal normally runs based on the number. And the problem we had last semester. So I don't know if McD is saying that this time around 1,700 students took their cut and it was successful. Then I'm rest assured that now the problem has been handled, and definitely we are going with session this time round. But if not, then I assure you, Doc, that we are going to have a lot of problems. That is according to my side, based on the experience we had last time. Hope my point is at home, Doc.
We have students who have done it by 2010, and I received 0 complaint about that. There were almost 1,700. So comparing with this number, I believe there's no need to worry, and we are ready for that one. So as usual, I'm always on standby in case of any challenge. I'll be able to assist you. So what I just want, or what I just need from you is just to prepare for the cut. So don't come with anticipation or the system will be troublesome or maybe there will be challenges, but I just want you to prepare for the cut and you'll be able to do the cut. Is that clear?
Yes, does that give us some way out? Members, let us agree before we start, because next week we will not have time to debate these things.
Good morning, Doc.
Good morning.
Okay, so about the time limit, I think 1 hour is enough, yes, but now the time limit, the time schedule, at least if it can be that long so that we don't have congestion in the portal. At the times you find that now that everyone wants to attempt the card at that particular time where it starts. So you find that it brings congestion now in such that some people there will be that time is clicking, time is counting, yet you are in the first question. So I think if the time tuseme like ianze kitu kama saa moja, waipee a time span of at least even 4 hours, but time limit for an individual, it
4
remains.
hours.
Yeah, such that hatutakuwa wengi at the same time attempting the questions.
That's what we are actually proposing. What I'm saying is this: we shall provide enough time, but every student will have restricted time. You see, if the cut is say 1 hour, so as a student you will access the cut for 1 hour, then it switches you off. Then we can allow it in the system to run for say 2 hours. So within those 2 hours, you will have your time. Will have your time for you to do the cut. Is that okay?
Thank you so much, Doc. I think that is now very clear, and I'm glad about that, because now the time tackled, now it means that even if there are 30 questions, then one question is given 2 minutes. And that is there will
be 30 questions. That one is true. You seem to be reading my mind.
Of course, very nice. So it seems like we are.
The time we will have is 45 minutes.
Not really.
Each student has 45 minutes. So you will be given 45 minutes to do the cut. So after 45 minutes, the system will definitely switch you off. As you log in, it starts timing you. So at the end of 45 minutes, it will have it will log you off. Mark D and B will be in the cut also. Will be there monitoring in the system. So if you have a problem, I don't see an issue, because we will be communicating. And the chat box is there for you to use. Then
question.
Anything else? Jen, are you now okay? Because you are the person who raised this issue. Jen?
It's now okay, Doc. I think now we can kick off with the class today, as we also plan on the same. We will also share with you if there will be a problem. I assure you that in the course of the week, we will also share with you and tell you how we want this to happen. Thank you.
That's fine.
Yep.
So as we are starting our class in a short while, just hold on as we do the technical bit. Are you able to access the LMS?
Yes, though personally to my side, I'm able to access it. Only that
Yes.
personally to my side, I'm able to access it.
You are able to access it.
Yes.
Okay. That's fine. Another person who has challenges. Please speak to us. Who is speaking?
Hello, Doc.
Yes.
Yes, we are accessing the notes online, but the problem is we can't download the notes. You see, when you want to read the notes, it's require you to be online. But it will be better if you are even offline to access the notes and read. So I will suggest that you make the notes downloadable.
We make the notes downloadable. Okay.
Yes, yes.
That one is hard. But if you are accessing it, then I'm happy. And those who are coming to ask for notes, it means they were looking for their own notes. Ama? Maybe on that way class. Yeah, I think for those who are attending this class very keenly, this one day I show you how to download the notes. So for those who are asking that the notes are not downloadable, it means you guys miss lessons. And I know very well if you can ask, I illustrated how you can use an app to access the e-learning and then download the entire course. And so just seek assistance, then you will have your notes without internet connection. That is clear. So we can proceed. Last time we looked at price indices, and we did see what a price index is, we began by defining what an index number is. We said this is a value that summarizes changes in a variable. So the change can take either form, and when we look at that change, we want to see the movements, and therefore these changes have to be defined as a proportion. We say that by the end of this topic, you should be able to explain the use of index numbers. You should be able to describe the various types and combinations of price indices. And then we'll look at the concept of investment, and that is specifically relating to the stock market. So when we defined an index, we did say that there are certain common types: the price indices, stock index, quantity index, cost of living index, and the like. Even performance index, as you're in class, we expect to do a performance index that will help you to graduation. In terms of the uses of index numbers, they are very, very important because they help us. If you see in the notes, they come up they help us to analyze the trends and certain tendencies. They are important in the areas of economics where they help us in terms of framing, and they are also good for purposes of tracking. So this is one good use of index numbers, and they also help us measure changes in terms of what is happening in the standards of living. So we're specifically looking at cost of the price indices because these are what we use to describe inflation. And we said that the following factors were taken into account when you choose an index: what is the purpose, what commodities, the choice of the base period. Remember, we said the base period is the starting point or the reference point, and where you're analyzing is the year of analysis. We did look at, we must choose the proper weights and also the price quotations. We know quotations come in different forms. So today we are starting off, and we want to start off by looking at the types of index numbers, and there are basically about 5. So number 1 is the price relative index, and with the price relative index, this measures changes in the price of a commodity over time. So we are looking at these changes, and these changes are in terms of a single commodity. So if we consider a commodity as an item, then we are concerned with what the changes in price that have taken place in that commodity. So we can do this in terms of analysis, and basically because this is a ratio, then we can find that ratio and express it as a percentage. So the first type is what we are referring to as the price relative index, the PRI, the price relative index. Now,
it's not clear. Do you have the black one? It's better. Black inakuanga better.
Are you able to see the writing?
One.
Hello? The price relative index, which you can abbreviate as PRI, we can get this by getting the ratio of the price PN divided by the price PO times 100. Why do this? Because PN, where N is the year, the price in the year of analysis, and PO is the price in the year of reference. This is what we refer to as the base year. The base year is where we start from, and the year of analysis is when we are doing that analysis. I think it's not very clear. I can look for the black pen, but we can look at this. So we want to consider a single commodity. Price relative index is for a single commodity. Now, if you consider, say, sugar, we want to look at the price of sugar over time. So if we can have, say, the year, then we have the price. we can look at how was the price in the year 2000. How was it in 2002? How was it in 2004? Assuming that it was 40 shillings per kilo in the year 2000. It went to 50 shillings per kilo in 2002. It went to 60 shillings per kilo in 2004. Then we need to decide when are we doing the analysis. That we can do the analysis, say, in 2004. So we can get the price relative index for 2004, which means 2004 is our year of analysis. The price in 2004 is our PN. But where are we making the reference from? Relative to which year? If we take the year 2000, then our price relative index will be the price in the year of analysis, PN, all over PO times 100. So if our year of analysis is 2004, then this will give us 60, which is the price in 2004, to the best year, and if you take 2000, that will be 40 times 100. If we are looking at it in terms of 204 relative to 202, then our price relative index shall be the price in 204, which is 60 shillings, divided by the price in the base year, which is 40 times 100. Do that, then we get it as I get the black pen. Okay. What is your price relative index for 204 relative to 2000? 60 over 40, what do you get? Someone to give us. This will give you 150%. This should be 60 over 50. This was supposed to be 50. Because we are looking at 204 to 202. If we do it for that, 60 by 50, this is times 100. That gives you 120%. Now, how do we calculate this? That if we look at 204 relative to 2000, that the prices increased by 1 to 150, which means there was a percentage increase of 50%. The price in this item sugar increased by 50%. If you look at the price relative 204 to 202, the price has changed from 50 to 60, which gives us an increase of about 120, and therefore the interpretation is the price between 202 to 204 had a net increase of 20%. There was a general increase in the price of this item that we are referring to as sugar with that margin. Number two is that this average is not good because it only considers one item. But if you look at consumers, we don't just depend on one item. Many times, we have a collection of items that we do use. So in this case, this price is not good as a measure of cost of living. Why? Because it only considers one item. So it does not indicate the general movement in terms of other prices. Because of this, then we can modify this to have a simple average price relative index. So our type number 2, this was number 1. Our number 2 is the simple average price relative index. Now, what this does is that it is a simple averaging method. We just get the price relatives, then average, meaning that with the simple average price relative index, we get the averages of the price relative index, PL or PO, divide this by N times 100. Where PL we know from the price relative index, the price in the year of analysis. PO we know that is the price in the reference year or the base year. But our N here is the number of items. The number of items. How many items are you considering? So if you are considering 3 items, 4 items, our N will be that number of items. For instance, if we modify this so that we are considering several items, look at the following case, that we want to consider the following prices. We have the year, then we can have the commodity. So under commodity, we have say sugar, then we can have bread. That's for the year say 2020. Then talk of 2022. Then talk of 2024. Then talk of 2026. Then we are looking at this commodity, sugar. If sugar was 60 shillings, then in 2022, it went to 80. In 2024, it went to 100. In 2026, say a kilo is going at 120. Because prices have been increasing. Look at the bread. If it was 40 shillings in 2020, 2022, it went to 45. 2024, it went to 50. In 2026, I think we are buying bread at 55 or 60 thereabouts. These are 2 commodities that we are considering. So, if we are looking at the simple average price relative index, so what we need to do is that we need to get what is it that was the general trend in the commodities relative to how many commodities that we have. For this case, therefore, our simple average price relative index, which gives us an analysis, are we in are in 2026? Can we look at it in terms of the year 2020 so that we see over a period of 6 years what has happened? So we consider sugar, which has gone to 120 from 60. Plus, we consider bread, because these are price relative indices. It has gone to 60 from 40. But then how many items are there? There are only 2 items. Then what you get, you express it as a percentage. So quickly, the price relative index for sugar, this is 120 divided by 16. That gives you 2 plus 40. 60 divided by 40, sorry. This gives you 1.5 divided by 2 times 100. So this gives you 3.5 all over 2 times 100 because we are expressing this as a percentage. So 3.5 divided by 2 times 100. So this will give you 175%. 175%. So how do we interpret this? That because we are considering a number of items, for our case we are considering sugar and bread, for our period 2020 to 2026. So from 2020 to 2026, that's 6 years. So within this span of 6 years, there is a general trend in the price changes. This general trend is of 175%. How do we interpret this? That the general increase in the prices of items was therefore 75%. That was the general increase in the prices of commodities. That is what we are saying. So if we have this, then we are able to evaluate over time and over a given set of commodities what was the general trend in terms of price changes. So if you say that things or items have become expensively, the plural, then it means there is that general increase in the price. If we consider one item, then that gives us the first price relative index of a single commodity. You consider a set by simple averaging, then you get the simple average price relative index, which is a simple averaging method. So on the surface, there was that general increase in the price of commodities, which is 75%. So if it's general, if I had 3 items, then my N will be 3. And I'll add the price relative for the 3rd item. Now, using the same argument, could we find out what is the general increase in the prices from the year 2024 to 2026? So 2024, we are here, and 2026, we are there. Let us find that general price change. Do we proceed? You can share your responses on the chat box. Somebody says I'm not clear. I think that's wrong. That's I'm very clear. I'm always loud. Unless there's a problem with the transmission. Somebody's getting 120. So whatever it is. Now, what is the problem with this simple average price relative index? The disadvantage with this is that we are treating all items as being equal because sugar and bread are being averaged. So we are treating sugar and bread as being equal, or the number of items, the number of commodities under consideration are being treated as being the same. However, under normal circumstances, not all items are treated equally by the consumer because of the differences in tastes and preference. Some of us don't use sugar. So to us, sugar, even if it is sold at 1,000 per kilo, it's immaterial. Some of us don't use carbohydrates, bread. We go for Numa and other things. So treating these items as being equal is false. And therefore, a better way has to be found so that we recognize what is it that we do to take into consideration the consumer tastes and preferences and other related factors. To this end, therefore, we introduce the weights so that not all these items are weighted the same by the consumer. Those who weight more sugar or those who give more weight to bread are there. So we introduce a weight that can differentiate in terms of taste and preference to this. That weight can be how much do you budget. We look at budgeting to these items. Assume, for example, you now want to add a weight that for this semester, I am going to spend 1,000 shillings on sugar. Then I'll spend 800 on bread. So this is being introduced to weight because we are not treating these items as being equal. If we were treating them as being equal, we would allocate the same budget. But because we are treating them as not being equal, we are allocating different budgets. So if we do that, then this gives us our third type, which is the weighted average price relative index. The weighted average price relative index. How is it computed? This is just the summation of the price relatives multiplied by the weight divided by the total weights times 100. Where we are introducing the weights, which we are denoting as WI. I taking the item by item divided by the total number of weights. As for this, we are introducing the weight as the budget. So the weight for sugar is 1,000. The weight for bread is 800. So if we introduce this to our weighting, as our weight, then the price relative index becomes the weighted average price relative index. So using the same example, we should now be able to find out. Say, for example, now, we want to see the price changes in the year 2022 to 2026. What can we say about the changes in the price? That our base year will therefore be 2022. We are doing the analysis in 2026. Therefore, our weighted price relative for sugar will be 120 all over 80 times the weight, which is 1,000 plus the one for bread. This is 800, then 45. So 800, not 860. The price is 60, sorry. 60 all over 45 times 800 divided by our weight is 1,000 plus 800. All this, because we are expressing them as a percentage, we give it at 100%. So we can do this quickly. I need not to be doing this for you. You need to do it so that we follow. Divide this, add the 2. Divide by this sum. Then whatever you get, multiply by 100. Then we see what you are getting. Please work with me. Work with me. If you work out well, you will get 142.59%. 142.59%. What does this mean? Remember, in the simple average price relative index, we saw the trend. With weighted price relative index, we are seeing the trend that there was a general increase by 42.59% from the year 2022 to 2026. We can still do the same from 2020 to 2026 so that we compare this very well. So if we do from 2020 to 2026, that was 120 all over 60 times 1,000 plus 60 all over 40 times 800 divided by 1,000 plus 800 times 1,000. Let us work out that so that we compare with what we got as 175. That can be our next example. So do that, then you can compare with what we got as we proceed. So at this point, we are seeing that the weighting is provided for, and the general increase in the price of commodities is provided for. But this does not bring out the true tastes and preferences of the consumer. So with this in mind, then there is need for us to have a better way of how do we go about looking at the issues of pricing. With this, therefore, we have the fourth. If you allow, I erase this. We have the fourth. I still want to use that example. We have the fourth index, which is the simple aggregate price index. The other one was simple average. But this now is simple aggregate. With aggregation, then we are dealing with the sum. So with this, therefore, we only need to see what is the sum in terms of the prices and the changes times 100. With these two commodities, we just want to see what is the sum. Say, for example, we want 2,000 to 2026. What do? We just sum what the sum of prices for 2020, that's 100. What about in 2026? The sum is 180. We are summing the prices. So with the price relative index, this would just be 180 divided by 100 times 100, which gives you 180%. Simple aggregate. Simple average price relative index gave us 125. Simple aggregate is giving us 180. The common trend is there is an increase in price. With the simple average, we saw 75% increase. With the simple aggregate, it is 80. So simple aggregate, because we are aggregating, so it tends to give a higher figure, unlike the simple average price index. You can as well do the same for 2022 and say 2026. For 2022, this will be 125. So it's 180 divided by 125 times 100. We just aggregate the prices, and that is what the simple average price relative is all about. As simple as that. Do the one for 2022 to 2026. The interpretation follows the same. The only disadvantage is that we are treating all items as being equally important to the consumer. But given what we said, the taste and preferences, they differ from consumer to consumer, so that is wrong. So number two, also we can look at it in terms of the units. We talk of a lot of bread in grams, a kilo of sugar. So the weighting, the way we talked about, in terms of the measures of the commodity, that becomes a problem. So what we need to do now is to see how do we weight. Weighting now comes in two folds. That we can introduce weights into this simple aggregate price relative index. How do we introduce weights? We can introduce weights in terms of quantities that are bought. So if we do that, then instead of simple aggregate price relative index, we now have the fifth type is the weighted aggregate price index. The weighted aggregate price index, which gives us the sum of Pn with the weight all over the sum of Po. Which we can simplify because we are considering the weight. If we consider this weight, therefore, it applies both to the current and the year of analysis, which implies that we can have the weighting being applied on both the current and the base. Now, if we do that, remember we are saying that the weight is what is WI. What is this weight that we are talking about? This weight can be in terms of the quantity, but either in the year of analysis or in the base year. If in the year of analysis, which we can talk of Qn, and if in the reference or the base year, we use it as Qo, so that it goes with the price. The price in the base year was Po. If the quantity in the base year is also Qo, the price in the year of analysis was PN. If the quantity is QN, then we are able to decide what is the weighting. Is it the quantity, the price, the quantity in the year of analysis, or the quantity in the base year? When the quantities, and please get this right, when the quantities in the base year are used, then we call that one left bias price index. When we are using the quantities in the base year, meaning that weighted aggregate price index is what is called less bias price index. And this is expressed as sum of Pn Qo divided by sum of Po Qo times 100. We are using the quantities in the base year. When we use the quantities in the year of analysis, Qn, then that price index is called partial price index, which therefore changes to sum of Pn Qn all over sum of Po Qn times 100. Remember, the difference in less bias and partial is the type of quantity that we are using. If we use the quantity in the base year, then that's less bias. If we use the quantities in the year of analysis, then that becomes partial. Now, because of the differences in the quantities, another person came up and said, no, we can average this, and this will give us an ideal index, which is referred as the Fisher's ideal index. The Fisher's ideal index. So with the Fisher's ideal index, is that the positive square root of the product of these two. So it is sum of Pn Qo all over sum of Po Qo times sum of Pn Qn all over sum of Po Qn times 100. This is the Fisher's ideal index. The Fisher's ideal index. So the weighted aggregate is giving us three different indices. And we even have the Marshall-Edgeworth index. I'll ask you to read about it so that I don't confuse you. I'll ask you to read about it so that I don't confuse you. So, given the prices of commodities, however many they are, and the quantities bought in the base year and the year of analysis, we are able to determine the ideal index. And that ideal index is the best. And that ideal index is what we refer to as the Fisher's ideal index, obtained as a result of the less bias and the Fisher's index for that matter. Let us look at an example so that we see how this works as we conclude our discussion on index numbers. So let us change the screen touch. Allow me to share the screen. Are you able to see the screen? Are you able to see the screen? Yeah, they are not. Please, are you able to see the screen? Look at that screen. Below are the prices and quantities of selected commodities sold at a certain kiosk in the year 2000 and 2010. So we have the year 2000, then 2010, the commodity maize, wheat, beans. Then we have the price for 2000, the quantity in bags for 2000, price for 2010, and quantity for 2010. This is a simple exercise. So, given this scenario, we need to look at how do we rate. So you have been given 2 years, because what you have is the commodity you have maize, wheat, then you have beans. You have the year 2000, then the year 2010. You have the price, then you have the quantity. You have the price, then you have the quantity. What we need to do is that we need to identify which is our price relative. So we are doing the analysis in 2010, which is current, relative to 2000. So this will be our price, PO. These are quantity, QO. Price, PN. Quantity, QN. So we must complete this table for us to compute those weighted aggregates. So in our table, add there the columns, you need PN, QO, you need PO, QO, you need PN, QN, and you need PN, it's PN, you need PO, QN. So we need to add these columns, get those products. It's better. So create these columns in front of this. Then get PO, QO, PO, QO, PN, QO, this and this, this and this, then this and this, complete this and get these totals here. That's what we want to use, the sum. Get these totals, because that is what we have to use. I must finish this hour by 9:45 or 8:45. You can just give them your summary. $144, $154. Data imeisha. Data kama imeisha, jipange. There is free Wi-Fi in the university. Share the values kindly. I did share the values. I share the values. No, now for maize, PO is 5, wheat is 95, beans is 150. For the price quantity in the year 2000, it's 20, then 8, then 5. For 2010, the price is 135, 160, and 320. For quantity in the year 2010 is 30, then 7, then 8. Those are simple figures to work with. Those are simple figures to work with. There is a table. For 2000, the price is PO. For 2000, quantity is QL. For 2010, the price is PL. The quantity is QL. Please do it quickly.
They don't know how to switch from one screen to
In the interest of time, that's what you will get. In the interest of time, confirm. POQO is 1610. POQL is 2015. PNQO is 5580. PNQL is 7730. 7730. Now substitute in the respective formulas for S per S per share and Fisher's ID index. Substitute. You see what you get. You can share on the screen what you are getting for partial. You label it with the P. Fisher's, you label it with the F. And less per S, you label it with the L. So if it's less per S, you say L equals 2. Partial, you say P equals 2. And Fisher's, you say F equals 2.
No. Only three. Mm. Find out your members. It's too soon. It's 64. You know, I have not understood the last sum. If you are doing all the things, then you won't understand. Watu nisaidie na formula. Formula ndio ilikuwa kwa ukuta, kwa ubao. I will tell you the formulas, but check that you have the following. Let's price index 364.84%. 346.84%. Partial price index 383.62. 383.62. Fisher's ideal index 364.63. 364.63. Meaning, partial increased by 246.86. Less bias, sorry, increased by 246. Partial increased by 283. And Fisher's increased by 264. So if you look at this, then the price is more than double. The prices of those commodities more than double over that period of 10 years. Now, if you look at this and you make a comparison, then you note that sometimes the prices of all commodities may change in the same proportion. If this is the case, then partial and less price indices will be equal. So when you get partial price index being equal to less price index, then it means all commodities change in the same. The prices of commodities change in the same proportion. Therefore, the weighting becomes irrelevant. Pay more attention to what I'm explaining. The weighting is irrelevant if the prices of all commodities change in the same proportion, because partial and less price will be the same value. If the quantities of all goods change in the same ratio, then the two indices will also be the same. And therefore, the two weighting systems will be relatively the same. So when you get less bias and partial indices being the same, it means the prices of commodities change in the same proportion, and also the quantities of all goods change in the same ratio. But is this normally the case? No. There is no way the prices of commodities can change in the same proportion, neither the quantities change in the same ratio. Because in practice, they can't be.
So the two indices will never be the same. This is because when the prices of commodities increase, people tend to buy less of that commodity because that commodity will have become relatively expensive. The normal argument that tastes and preferences induce different market dynamics. People tend to go for cheap things. So when they increase the price, the quantity demanded reduces. There is always that inverse relationship, and the two will never be the same. You need to understand also that with per share, because we are using the quantities both in the year of analysis, it shows the relative change in the cost of purchasing. What is the change in the cost of purchasing? Because of the reference period. Therefore, it's more realistic as it reflects the tastes and preferences of people. Less prices, on the other hand, is less expensive to compute because it only requires prices in the base year. That is what I can comment. So at your own free time, look at what it is. This is the results that I worked on. Check for my working, check if I got it right. So you can also, during your free time, check and look at this. We have the items A, B, C, D, E. You can screenshot. We have the prices for 2020 and 2021 and the quantities for 2020 and 2021. Do as many of those computations as possible. The solutions are provided there, but check yours. Then we can see what to do. As an exercise, screenshot that. As an exercise which we can do in the groups, screenshot that. Where a farm is using 5 raw materials, A, B, C, D, E. We have the prices, best period and current period. Best period, current period. Best, the year of reference. Current, the year of analysis. Then you have the number of units given in terms of amount. This is not the quantity, this is already amount. So you must calculate to get the quantities for the best period and the quantities for the current period. If in the best period you had 8, and the amount sold was 200, so 200 divided by 8, you will get the quantity. 65 divided into 1950, you will get the quantity in the current period. That's what you do to get the quantities bought. Then you can proceed to get this the standard exam question. So look at it and see. When you are asked to see using none of the weights, that means you are looking at the simple aggregate price index. Simple aggregate price index. I think I'm clear on that. So that's the work solution for me. Then as we conclude, allow me to briefly look at the stock market, but I don't want us to come to this. In the next 10 minutes, we will be concluding. When you talk about the stock market, we are looking at the buying and selling of shares of public quoted companies, government securities, and municipals and stocks of municipal authorities. It's an investment market. You buy and sell shares and other securities. So we trade in stocks. And these stocks are government stocks, government bonds, the ordinary shares, and the like. The owners of the ordinary shares are called ordinary shareholders. And these people have voting rights. Unlike the preference shareholders who only provide their funds for investment, they are paid a fixed rate of interest and they have no voting right. That's the difference between ordinary shareholders and preference shareholders. We are dealing with stocks, and in stocks we are dealing with shares. A share is just as small as the smallest unit of owner's capital. When we talk of stock, we are looking at a bundle, the minimum share that you can have. Many times, like yesterday, the CS Treasury was announcing the selling of shares in KPLC. So if this is the case, then people buy. They have just closed the one for pipeline. You invest in them. So you invest to get interest or returns. You will be doing this. But why must every country have a stock market? Every country world over has a stock market. Because a stock market provides a ready market for buying and selling of shares. It spreads the risks for investors, have the opportunity to invest in different companies. So if you fear that your company will go into liquidation, then you can divert. Then you start to register. It's very expensive to obtain quotation because there are a lot of fees, audit fees, brokerage fees, legal fees. So if when a company fails to pay for such fees as required, they are registered. There are no secrets in quoted companies because you are required to publish all your financial accounts. If you fail to publish, then you are registered. So when you fail to publish, you are registered. When the creditors lose confidence, it goes into liquidation. So when creditors lose confidence, those who are supposed to pay you, then they'll not trade with you. And of course, you have no control over the incoming shareholders. Imagine if Sifuna now bought shares in Unias Sugar. You will see how it will transform. Imagine if, because you are calling yourself Sisi ni Sifuna na Sifuna ni Sisi. Linda Mwanaiki. But others are also saying Sisi ni Kuda na Sisi ndio tupo. Na wengine wanasema Sisi ni Azimio na bado wanazimia. That is a story for another day. I don't want to go deeply into that. But whoever comes in may have this influence, which may affect the company's policies. So that is what the problem is. But we talk about investment. What must you consider before investing in shares? One is the nature of the product. Checking today's daily. Check the news. You want to invest in what? We have agricultural, industrial, financial, banking, alternative investment, and what have you. Check the product, the nature of the product you want to invest in. Then you look at the performance of the company. Are the shares of that company easily transferable? If they are not easily transferable, it means that company has a poor performance record, and therefore it does not command a high demand in the market. It's very difficult to sell such shares. Diversification. Buy shares in different companies, have different products, so that you spread risks and have a wide product mix. If an agricultural fails, then you have industrial. If industrial fails, then you have finance and banking. If that fails, then you have an investment in alternative market. Check out what these are all about. Look at the growth rate of the company. You want to go where the growth rate is favorable. How do we measure the growth rate? And when do we say that it's favorable? If it declares more dividends year by year, and the increment of growth in terms of dividends declared, the returns. Security of the investment, go where it's guaranteed. And where do we have guaranteed security for investment? It is in those of the government. Buy Safaricom shares while floated by the government. Buy Kenya Power shares when floated by the government. Buy pipeline shares when they are given by the government. You never lose out dealing with the government, even if it takes how long. That's what you consider in terms of buying and selling of shares. But generally, what's investment? Investment is committing of funds today for returns in the future. You are investing in your education. You are committing funds. You are paying funds. The government is investing in you today because they expect to get returns in the future. Why should you commit your funds today? What should you consider as you invest? Whether it's shares, whether it's a business, whether going into the real estate, the houses, what must you consider? One is returns on investment, the interest, the profits, the dividends. Normally, you invest where the higher returns, because the higher the returns, the better the investment. Security of investment. You invest where there are fewer or minimum risks. But it's argued that the higher the risks, the better the returns. You go for where it's easy for you to convert the investment into cash. Liquidation. So what is the degree of liquidity? How easy is it to convert that investment into cash when you need it? Then, of course, how long does it take to pay back your initial capital invested? The payback period. So usually you must invest in where it takes a short period for you to get back what you initially invested as capital. Issues of taxation are there. So you should go into areas where there are low tax rates or it's tax-free. The lower the tax rate, the better for you because you will have more, you will get more. Because investment refers to committing of funds today for purposes of maximizing returns in the future. You want to maximize returns. So you maximize. You don't evade tax, you don't avoid paying tax, you pay. But there are those investments that the profits are tax-free or have a lower tax rate. That's what you go for. Then finally, look at the growth rate. Go for those activities whose funds value appreciate with the time, rather than those that depreciate. That's what is key. Those which appreciate, not those which depreciate. These are the factors to consider before making a viable investment. Now I have an exercise here. With that in mind, assume that XYZ has been retrenched from his job or has retired, and you have 3 million as lump sum, and you need to venture into investment. This XYZ is undecided as to whether to invest in the matatu business, buy shares, or build rental houses in an upcoming town like Kibabi here where the student. He approaches you as an expert to advise him on which option he should invest in. Now, this XYZ is Dancun Wasike. Can you advise Dancun Wasike on what to invest in and why? As we conclude the lesson, you can unmute and then advise Dancun Wasike. I'm ready to go. I'm listening. Unmute, then advise Dancun Wasike what to invest in. Of this 3 million, should I go into matatu business? Should I buy shares in Kenya Power, the one that the CS was yesterday? Or should I go for rental houses around Kibabi University? So I have those 3 options. Which option are you advising me to go in for and why, as an expert in investment? Kazi kwenu. Furuha. Unmute and talk. Unmute them. Furu, I don't want to talk.
Okay, I was saying on my part, yes, on my part, I'll advise that man that to invest in the buying of shares like in Kenya Power, because when you look at the returns, hello?
I'm waiting, I'm listening. Advise me, I'm the XYZ.
Okay, I'm saying that you should rather invest in buying shares like in a company like. I'm saying that you should.
You are not clear to somebody else?
Buying the shares in a company.
I buy the shares in a company?
Hey, Doc, I get you. Are you getting me?
I want to get advice on why to invest in.
Are you getting me?
Yes, please.
So I was saying this, that you should invest in buying shares in a company.
Yes.
Because when you compare the returns, the returns.
Can you stop and talk?
Good morning, Doc.
Good morning.
Thank you so much. Now, according to my side, I think these people should build the rentals.
So for you advising you to go for the rentals, why?
Thank you so much. Now, let me bring it down. Thank you so much. Let me bring it down and have a broad base. For instance, around Kibabi University, remember we have students
Yes.
that are renting these places. So as much as these people will construct these rentals, the first thing is that they will have an income where the students will rent these places and stay. That is the first one.
There's ready
And
market.
the second one, we have people doing business. They can even rent their places to carry out business. In return, they're going to have what you call an income. The third one, there are also people
So
that
do you think
move from
it's lower than that of matatu business? Because I have 3 options.
yes.
So you are telling me to go for rent, but it's a business like any other.
Yes.
I need your swali ya mtihani. So how would you answer?
No, you're not clear, sir.
This is a standard question that you need to understand. So how will you respond? Hao wasichana wajibu swali, they never answer, lakini ndio mtakunywa supu kabisa. Naongea nafunza, mnaongea. Chezi sana. Ongea tukisikia vile mnaongea.
Hello, Doc. Hello, Doc.
Yes.
I think you can invest in rental houses
Why?
because rental houses can can provide stable monthly income from the tenants.
Stable monthly income.
Then land and buildings, their values increase over time.
Excellent. There's appreciation in rental or estates.
Yeah.
Another person?
In terms of operational risk, the rental houses have few daily management problems.
They have fewer risks. Unlike the matatu business that can get an accident and it's written off.
Yeah.
Another person?
Okay, good morning, Doc.
For you have given 1.5 points. So out of 20 marks, you have only scored 6.
Good morning, Doc.
Good morning.
Okay, for me, I think the best advice for you is that you should just invest
Who is
in.
speaking? Who is speaking?
This is Silvery.
Silvery, good. I want to know those who participate in the class. They may have an advantage.
Okay.
Class participation.
So I would advise that you go for the buying of shares.
Good.
Because it is very simple and in quotes, I can say it is the laziest way of getting rich.
Because to buy land and build rental houses, because land, because they are tangible assets, they grow in the market.
Who is speaking?
Somebody has just cut me off.
I'm wondering who is speaking. That guy who is talking of buying land and doing what?
Okay, so I was saying this amount of money will appreciate rapidly and increase the value over time. Unlike the state whereby you will go for, let's say, building rentals. In the first place, you will need to buy a land. In the second place, the building materials, all that, the cost for building the rentals, it will be much expensive, or you will spend a lot, and you end up before even you completed your rentals, the money is you've used all the money, and maybe some of the things you have not completed. In the second place, why am I discouraging the option of buying a matatu? What if you just buy a matatu, you've spent all your 3M in that matatu, then accidentally gari yako imepata accident, that 3 million itakuwa imesplash tu hivyo.
So the risks involved, you are talking about the risks.
Yeah.
Yes. Another one?
Yes, hello.
Good morning, Doc. Good morning, Doc.
Hello.
Who is speaking?
Okay,
Yes.
this is Robert.
Proceed,
Actually,
Robert.
I think Mr. XYZ should be advised to invest in like building rent because, as we know, building of rental value will be appreciating as from
The appreciation
since we build.
aspect, we saw it.
But
There are very many
I
points we have looked
discourage.
at for investment. I want to get your argument.
Pardon?
There are many
Pardon?
points there to talk about. Appreciation, yes, we have looked at it. Invest in those that appreciate.
Hello.
Yes, hello. Hello, Doc.
Yes.
Hello,
Yes.
my name is Cynthia. I was going for the option of the matatu.
Yeah, that's great to have the first lady talking in my class. Pick it up. Cynthia who?
Cynthia Dominic.
Cynthia Dominic. Proceed.
I will go for the option of the matatu because
Yes.
when the matatu has a cash turnover and if it's run well daily, there will be an income that will come if you manage the property you are
So the
riding on
period
the
is
road.
short.
Yes, the money will come daily, and this will lead to a lot of money, and this person will be able to invest in other businesses.
Sawa.
Yes, hello, Daktari. This is Jack speaking.
Sydney.
You get me? Before I advise this guy, nitaanza kumuuliza swali kwanza. Then I'll ask
In
him.
English. You will answer that question in English.
Yes, in English.
Yes, Dr. Yellow.
Waiting for your response.
Then I'll ask this guy first of all. Are you looking for an investment which will earn you daily income, monthly or annual income? For instance, let us say, if he agrees for daily income, because 3 million is good money, I will advise him.
The question is
go
just
for
on investment. What do I invest in? I have 3 million. I want to be getting returns in the future. Whether they are
yes,
daily,
then I'm telling you,
monthly, annually.
I will advise him to hello.
Yes.
I will advise him to go for
Say
petrol
your name.
station because no matter how it might come.
You say your name first.
Hello, Doc. People will have to go and fuel there. So that's marketable.
Hello.
And he will able to earn daily. But for example, if he wants to earn monthly, I will advise him to go for rentals. But annually, I will also advise him to go for the shares because you won't tell me that you have shares in a company, then you are expected to earn something daily. That's a great lie. But when it comes to matatu also, it has its disadvantages because you cannot be the same person who wants the matatu and you want to manage. Then there will be some looting of funds in that project. Are we together? So I would rather prefer this guy to go for the petrol station.
Hello.
Together.
You are bringing in petrol
Hello,
station, which
hello,
we
Doc.
talked about. I was
Hello,
there.
hello.
Hello, Doc.
Hello, Doc.
Hello, Doc.
I need 3 more people,
Yeah,
then we conclude.
Hello,
my
Doc.
name is Edwin Loake.
Edwin.
My option, yeah, Edwin Kilwake. My option is this: you go just for the rentals. Since rentals has a steady income, like it doesn't depreciate, but it always appreciates, as they have already said. When the tenants are supposed just to pay a fixed amount, unlike matatus where like a day you may get this amount, it fluctuates. Yeah, that may be a bit
tricky on coming to business as an investor. You should always venture in making profit. In buying shares, you see the risks here are very diversified. Like you have less control of the company. So like a company, you have to make a decision as in unison. So you have like less control. Unlike this rental, where you can decide by your own as you are the owner of the business. When you compare it to this matatu, you may have that access to control, but you may not control that amount which is coming in because you should have employed other persons whom they collect for you that money, these conductors and drivers, and they may be biased on the way they take the money, which may be very tricky for an investor. So advice to you, just look for the rentals, since they are very cheap to control, and you also have a good access to them. Thank you.
Hello, dog.
Hello, dog.
Hello,
Hello, dog.
Juma. Is
Hello,
Juma
dog.
speaking?
Who is
Hello, dog.
speaking?
Juma,
Hi.
Juma.
Hello, dog.
Hello,
Do we
dog.
have the lady?
Hello, dog.
Hello, dog.
The lady to
Hello, dog.
Hello,
Hello, dog. Hello, dog. Hello, dog. Mr.
It
Joshua.
is Juma speaking. Hello, dog. Hello, dog.
Doc, as my opinion, I'll go for the rentals.
Hello, dog.
Hello.
Hello, dog.
Hello.
Ongea.
Hello.
Hello, dog.
Bye. Hello, dog. Yes. Continue.
Hello, dog.
Yes, who's that talking? Hello, dog. Yes, dog. We are listening.
Dok, hata nikaa ameenda.
Hata ni kama ameenda. I'll suggest to go for the rentals ban.
Kwani kuna watu huku bado wanangoja ni do, kuna bado wana suggest.
Doko amongelelea mambo na kat. Nani alisikia aniambie?
Oya.
Hey man, kati inaanza saa ngapi?
Saa 11
Are you
Jioni.
Mr. Doc?
usiku asubuhi.
After class.
Ugani Mori? Ama. Kupikia nini sasa?
Kati ni next week.
Okay. Na bana
Sure
kati
this week.
na bro.
Buati cut ni this week ama next week?
Next week.
Jana.
Lini?
Kati ni jana.
Acha uongo, kati ni this week. Kati ni sahi hadi.
Next week.
Au Mamoreso wamesema wametoka kufanya kati sahihi. Hebu mtuambie sasa.
Ndio nataka kufanya katido.
Kati imekuwa jana na utoka hapo.
Wewe mwenye unasema kati ilikuwa jana ulifanya na nani?
Confused element huyu bana.
Okay, ulizia
Mtu namkia pombe alafu unakuja kuongea zako muone.
Sema kwa serious bana.
Serious na nini?
Bana, mambo ya kati hiyo story lenga.
Unauliza tutaka kujua tu kati inaanza saa ngapi ama itakuwa lini?
Amesema ni next week. Leo.
Watu mnyamaze bwana.
Alafu mseme amechota hii unit vizuri ya pin location ni gani?
Niliona mwingine.
I think wamesema opposite. Wachangia ndo watapata.